Hello everyone, today's video is about tax relief on pension contributions. Interesting report released from one of the big pension providers which said that 80% of all their scheme members who were eligible for higher rate tax relief were not claiming higher rate tax relief. I mean, that's staggering, to the tune of about £800 million. So, I mean, that's an awful lot of tax relief that is not being claimed. So just a reminder how you would do it. So let's say, for example, you are a higher rate taxpayer, you're paying 40% income tax on your earnings. Let's say you're an employee and you're getting a wage, but this applies equally to people who are self-employed or partnership profits. So you're paying 40% basically on anything that you earn. At that point, your marginal rate is 40%. If you were to earn more, it'd be taxed at 40%. So let's say you make pension contributions. Let's say you write a check to your pension fund for £8,000. It's a personal pension contribution from you to your pension pot. You write a check or wire transfer £8,000 into your pension fund. Now, the mechanics of the tax relief would be that of that 10,000, the pension fund would automatically claim 20% tax relief on that. So, but specifically on what we call 20% on the grossed up amount. So, taking the £8,000 example, £2,000 would be topped up by HMRC. So if you were to go into your pension fund, you would see the £8,000 coming in from you, and then HMRC credit the pension fund another £2,000. So that's what we call a gross contribution of £10,000. So HMRC have given £2,000, which is 20% of the gross, and you've contributed £8,000. So £10,000 hitting your pension pot. Now, if you earn if you're a high rate taxpayer to a significant degree, what happens is that there's more tax relief, and on your tax return, you would apply for the remainder of the tax relief at 40%, which occurs by basically extending the point at which higher rate tax kicks in. So on your tax return, rather than having 40% kick in at earnings of £50,000, on that example, it takes it to £60,000 because the gross pension, we've already said, is £10,000. So you only start paying 40% from 20%. That's the increase from the basic rate to the higher rate when you get to £60,000 instead of £50,000. And that's how the mechanism works for the higher rate tax relief. So basically, it delays the point at which higher rate kicks in. So on your tax return, you are paying 20% tax that much longer, and on your pension pot, HMRC are writing a check for 20% of the gross. So when you combine the two together, that's 40%. So when we talk about 40% tax relief, that's how it works, the mechanics. Half is given on your tax return and half is given by HMRC crediting your pension pot. Now, the one that's being talked about in this report where people are failing to claim the relief, it's on the second bit, as it were, the bit you have to do for yourself by claiming it on your tax return. The automatic top up by HMRC, that is what it is. It's automatic. So you don't have to do anything about that. Your pension fund will let HMRC know. They'll go, hey, £8,000's been credited to this guy's account. Please, can I have a top up for the remaining 2,000? That's all done behind the scenes. You don't need to worry about that. But it's the other bit, the other 20% of the 40% relief, as it were, that you have to claim through your tax return, and that's where people are failing to do it. And that is what's costing people up to £800 million a year, they reckon, for this one particular provider. So do make sure you are claiming it, because it's not automatic on that tax return. So it's great the fact you've paid it. That's the first thing. You're paying into a pension. Great, that triggers the relief. But for goodness sake, do not forget to claim the difference. Now, on if you're on that example of 10 grand, if you're just into earnings of paying higher rates, so let's say you earn £55,000 of salary, then you're going to get the higher rate relief on the amount that's going to be in the higher rate. So on that example, you're going to get the 20% top up by HMRC, the £2,000, but then the remainder of the relief that you get in your tax return will only be on the £5,000. So it brings you down into being a basic rate taxpayer again. So basically, the more you are earning in the higher rate, the more scope you've got for doing a bigger contribution to get you to as low a rate as possible. Ideally, you want to pay as much pension to get you back to the basic rate. But also you need to worry about other things like the so-called annual allowance, and I've done a separate video on that, that on the flip side of paying unlimited amount of pension, there is a cap. You cannot just pay an unlimited amount because there is a certain cap. So within the balance of hitting the cap and cash flow constraints and tax, you need to weigh all these up. But for a lot of higher rate taxpayers, if they could afford to do so, they could afford to entirely wipe out their higher rate exposure to tax. So that was just an overview on higher rate relief for pension contributions. If you like this video, please do subscribe here, and I will see you soon.